My comments today complement another tax loss harvesting video previously recorded by Bethany Muensterman, an investment manager here at Payne Wealth Partners. If you're unsure what tax loss harvesting is, you'll first want to watch Bethany's video and then come back to this one. Now, one key point to remember is that tax loss harvesting applies to taxable or non-qualified investment accounts. It does not apply to retirement accounts like IRAs or 401ks. Now, in our firm, many tax loss harvesting decisions are coordinated through interactions between our investment team and our planning team. Why? Well, because each member brings different knowledge and different specialty to the discussion. As Bethany described, overall portfolio decisions are very important to ensure the tax tail doesn't wag the investment dog, so to speak. In other words, it's probably not wise to throw your desired portfolio makeup, or what we would call asset allocation, completely out the window just to harvest losses. That's one key part of what our investment team is evaluating. They must also avoid breaking a certain rule called the wash sale rule. To complement this investment analysis, wealth planners like myself are often looking more closely at each client's specific income tax situation. In fact, there may be instances when tax loss harvesting, from a planner's perspective, may not be wise. For example, under current law, taxpayers who fall below the 25% federal tax bracket are taxed on long-term capital gains at 0%. That's right, you heard that correctly, 0%. Now, there may be state and local taxes to pay, but those are so minimal compared with federal income tax. So if someone is in that situation, we may advise against tax loss harvesting. In fact, we may even consider realizing long-term gains that year, since they're only taxed federally at 0%. There are other planning considerations in that decision that we won't cover today, and there are other reasons why we may not advise tax loss harvesting for someone in a particular year. Now, in the previous video, Bethany told you how losses can offset portfolio gains. If those losses are more than your total gains, then additional losses can often offset ordinary income up to $3,000 per year per tax return. As planners, we want to think about this because it may be very valuable to some high income earners. The bottom line is this: we believe a team approach can often provide well-informed recommendations and decisions in these matters. If you have questions about tax loss harvesting in your investment accounts, please feel free to contact someone on our team at Payne Wealth Partners. Remember, Uncle Sam isn't really your uncle, so be wise in your planning.